Hi, I'm Professor Brett Frudenberg, and we're going to be speaking about working from home, claiming a tax deduction. First of all, I'd like to acknowledge the traditional custodians of the land on which we're meeting, pay my respect to elders past and present, and I extend that respect to all Aboriginal and Torres Strait Islander people. What we're going to be discussing in this presentation is an overview of the possible deductions when working from home. As we previously said, generally your home expenses are private in nature, whether you own your own home or rent it. Though if you do regularly work from home, because you can't always work at work, then you may be able to claim a tax deduction for a home office. Now, given COVID-19, the ATO released some special rules in terms of claiming 80 cents per hour. However, those rules only apply from 1 March 2020 to 30 June 2020. If you've been working from home prior to that date, or indeed you can actually use the standard rules for the whole year from 1 July 2019 to 30 June 2020. So it's not mandatory for you to use the 80 cents per hour rule, and you can actually apply the standard rules. So what I'll do is actually discuss what exactly those standard rules are and what they will mean in terms of your tax deduction. The way you work at home might actually affect what exactly is tax deductible. And so this initial question is so important for you to reflect upon. If you work at home and you have no dedicated work area, but do some work, i.e. you work on the kitchen bench or the dining room table. So that's known as a no dedicated work area. This can be compared to if you do actually have a dedicated work area, an office at your home, but your home's not your principal place of work. You normally do work at your boss's place. That would be known as a dedicated work area in your home. And then the third situation is where your home is actually your principal place of work and you have a dedicated area there that's unlikely to be suitable for domestic use. Good example of this is like a doctor with a doctor's surgery attached to his or her home. Now for this presentation, I'm going to really be focusing on the first two, the no dedicated area and a dedicated area. This third example is generally more relevant for someone who's running their own business compared to an employee. In terms of your home office expenses under the standard rules, there's some important things that you need to think about. Did you actually spend money? And were you reimbursed in terms of those additional expenses that you incurred from working from home? Also, did the expense that you incurred from working from home, did it directly relate you earning income in terms of your employment wages? Thirdly, what extent does that expense relate to private and domestic use? Because some of your expense may be deductible, but if it's partly for private use, then that proportion that relates to private use is not tax deductible. Also, do you have the records to prove the expense? Because as a taxpayer, the onus is on you to keep those records. So please reflect on those 4 initial questions as well, because they're so important in terms of whether you are able to claim a tax deduction. So let's look at the standard rule where you have no dedicated work area. So this is when you're working at the kitchen bench or the dining room table. You can only claim a tax deduction for the additional expenses you're incurring from working from home in relation to office equipment that costs $300 or less, but also remember to reduce it by any private use of that office equipment. So there must be a printer, a headset, a mic, a chair that you use at home. Also, if you've got office equipment that costs more than $300, then you'd be able to claim depreciation on that. But again, excluding the private use. So a good example of this may be a computer that you use at home. Also, you can claim as a tax deduction work-related telephone and internet expenses and the cost of electricity to power the computer while you're using it for work. So really, when you have no dedicated work area, your tax deduction is only limited to these 4 possible areas. Because you're probably sharing that area with other family members, you can't really claim the additional cost of lighting and heating or cooling that room, because really the kitchen would have had a light on anyway because someone else is probably in there. And so really it's only these 4 additional costs that you can claim and not actually the cost of the lighting of that room. So this is a standard rule when you have no dedicated work area when you're working from home. What happens if you do have a dedicated work area, i.e. a home office at your home? What happens then? So the possible tax deductions then, when you do have a dedicated work area, include the lighting and heating and cooling of that room, the electricity for the office equipment used in that room, telephone and internet relating to work, cost of cleaning the home office, office equipment costing $300 or less, i.e. a printer or a headset, a mic or a chair. And in terms of office equipment costing greater than $300, then you'll be able to depreciate that. But again, always reduce that by the private use of that piece of equipment. So if you're using the computer only partly for work, then only that part that you're using for work will be depreciable for tax. And so you need to make that on a reasonable estimate. So really think about that in terms of your private and work use of that equipment. Also, you'll be able to claim the repair cost of that office equipment, again, excluding the private percentage. Also, office consumables such as printer, ink, pens, paper, stationery, extra data charge on your mobile phone, and maybe software. But with software, always think about, is its effective life greater than a year? If it is, then you're likely to have to depreciate that rather than claiming it upfront. So these are all potential tax deductions that you can claim in a dedicated work area. Things that you can't claim, well, the private proportion of that expense, your occupancy expense, so your rent or your interest on your home loan, the house insurance, the council rates, the land tax. None of that will be able to be claimed as a tax deduction for your home office. They're known as holding costs. And the idea being is, well, you really incur that rent and interest regardless of whether your home had a home office or not. And so you can't claim that as a tax deduction. You can compare that if your principal place of work is at home and you had that dedicated area, i.e. the doctor's surgery, then the doctor could claim that. Okay, but for most of us, that's not relevant. Also, you can't claim a tax deduction if the work paid for or provided the office equipment. So if work actually gave you a computer to use at home, well, then you can't claim that as a tax deduction because you have no expenditure. If work paid for the paper that you're using at home, again, you can't claim a tax deduction for that. Also, if work reimbursed you for the expense. So yes, you had some work-related phone calls, but work actually reimbursed that amount, well, then you haven't had really that expense. And so you can't claim a tax deduction for that. Also, private expenses such as food, coffee, alcohol if you had a bad day at work, or yoga because you wanted to relax after work. And also traveling from home to work, generally for most of us, is private in nature. So even though coffee may be helpful when you're working, you can't claim that as a tax deduction. Also, notional expenses aren't deductible. I spent 2 hours cleaning my home office. I didn't actually pay anyone, I just did it myself. I can't claim that time that I did as a tax deduction. But I could claim the cost of the cleaning products that I used in cleaning the office. So notional expenses are not deductible. You really had to pay someone to clean your office. So if you do have a dedicated work area, there's two methods to calculate your possible tax deduction. There's a fixed rate method and also the actual running cost method of that home office. Now the fixed rate method basically covers your phone and internet and computer consumable and stationery. It's a fixed rate of 52 cents per work hour from home. And that 52 cents basically covers the running costs, i.e. the electricity, lighting, cooling, heating for the computer and printer and the cleaning expenses. So just the running expenses. In addition, you can claim as a tax deduction under the fixed rate plus method, your phone and internet expenses for the home office in terms of work purposes, computer consumables, i.e. printer for your printer and stationery. You can claim your office equipment costing $300 or less, i.e. the cost of a headset or a mic or a chair. If your office equipment costs more than $300, then you'll have to depreciate it. But again, always exclude the private percentage. Software, but also always consider whether it's got an effective life of a year or more. The software is only going to last 12 months, then you'll be able to claim it up front. If the software is likely to last a number of years, then you're going to have to depreciate it, similar to a laptop. You need to keep a diary for at least 4 weeks to show generally how many hours in that week you would normally work from home. And then you can apply that 4 week estimate to the rest of the holiday, rest of the working year. but also make sure you exclude holidays, etc. And so we won't be working generally 52 weeks of a year. So make sure you exclude those weeks of annual leave and public holidays. So you can see with the fixed rate method is 52 cents per hour, plus then some of the other expenses that you've incurred. In comparison, the actual running course is a little bit more detailed. You'll need to work out the actual running expenses of the home office. How much of the expenses of your home reasonably related to you working from home? What you might do is use a proportion of the home office floor area compared to the whole house. Say my home office is 10% of my whole house. Plus then I need to consider how many hours I'm actually generally working in my home office. I can then apply this to the total running cost of my home. But remember, that will not include rent, will not include interest on my mortgage. You'll need to keep your receipts in relation to those expenses so you can validate that you actually had those expenses. When you're trying to work out your phone and internet expenses, you need to think, what is the actual work-related use of both my phone and internet expense? That's both for the fixed rate and the actual method. You need to formulate a reasonable method, such as a logbook or diary demonstrating a pattern of use. So you might keep a logbook for 4 weeks to demonstrate that you're using your phone 25% of the time for work-related courses. Then you can use that representative period for the whole year. Again, remember to exclude holidays. Alternatively, you can claim a deduction up to $50 using a set rate. That set rate provides that you'll 25 cents for a landline call, 75 cents for a call from a mobile, and 10 cents for a text from a mobile. So you can see in terms of estimating your phone and internet expenses, there's a couple of different ways that you determine the reasonable estimate of that. If your home is your principal place of work and you have a dedicated area that's unlikely to be suitable for domestic purposes, i.e. the doctor's surgery, you'll probably have to be more likely to be running a business. There's separate rules to consider here. I haven't covered these in detail. One of the things you want to know though, if you do have if your home is your principal place of work, what it means is that likely when you sell your home in the future, you will not get a full exemption from capital gains tax, because the office part is likely to be a taxable capital gain. If you think this is your situation, it's highly recommended that you seek advice to actually determine what you can claim and how it will affect your capital gains tax in the future. So just in summary, if you have no dedicated work area, i.e. you're working from the kitchen beds, you can't claim the running expense, i.e. electricity for the lighting, but you can claim the work-related phone and internet expenses, decline in value of any work computer that you use at home, and in other office equipment, say a chair, but you can't claim the occupancy expenses, i.e. the interest on the mortgage. If you do have a dedicated work area, i.e. a home office, then you can claim everything there apart from the occupancy expenses. If your home is your principal place of work, then you'll be able to claim all of those, but only to the extent that it relates to work. Really, for most of us, the first two columns are likely to be the situation. While we might get excited about claiming a tax deduction, if I claim a tax deduction of $100, am I getting $100 back from the tax office? Well, the answer is no. Spending $100 on something that you can claim as a tax deduction will not save you $100 in tax. It is not dollar for dollar. It will still cost you money, but you're just saving on the amount of tax. And the amount of tax you save depends on the tax rate you're applying. In a way, if you have to work from home, it's probably better if you can get your boss to pay for the course. Then you don't need to lodge a claim for a tax deduction, and the full amount has been covered by your work. Of course, that's not always possible. Here we've got an example just to show how you can be out of pocket if you're paying for the cost of you working from home. So here we've got an employee, she's going to have to work from home. She goes to Officeworks to buy a chair for her home office, and that costs her $100. She then goes and completes her tax return, and she claims $100 as a tax deduction for that chair for her home office. On average, she's paying tax at 30%. What that means is that $100 deduction is saving her $30 in tax, because her average tax rate for this example is $30. What that means is that she's still $70 out of pocket. She spent $100 on the chair. She's got essentially $30 back from the tax office, but she's still out of pocket of $70. So here you can see how when you spend money, while it's good to claim a tax deduction, you are not getting dollar for dollar back. And the reason for that is that in terms of our tax payable, it equals our assessable income less our deductions times the rate minus the offset. Your income less deduction is known as your taxable income. In terms of rate, for resident individuals, our marginal tax rate depends on our taxable income for the year. For the first $18,200, there's essentially no tax payable on that. That's a tax-free threshold. Between $18,200 to $37,000, we pay 19% for each dollar over $18,200. For $37,000 to $90,000, we pay 32.5% for each dollar over $37,000. For $90,000 to $180,000, we pay 37% for each dollar over $90,000. And then if you're on the highest marginal tax rate, your taxable income's greater than $180,000, then you'll be paying 45% for each dollar over $180,000. For individuals, also we need to think of Medicare levy, which is basically a 2% rate over a certain threshold. For our example, let us say that we're in the tax bracket of $37,000 to $90,000. What that means is that our tax will be $3,572, which is essentially the tax on the first $37,000, plus then 32.5% for every dollar over $37,000. If we're claiming a $100 tax deduction, what that means is that we're saving $32.50 in tax. And so essentially we're still $67.50 out of pocket. Okay, so the tax deduction is just sheltering income at that relevant tax rate. You can compare that to an offset. If you're eligible for an offset, that's saving you dollar for dollar in tax. So for example, if you're eligible for the low, middle and income or tax offset, that offset will be saving you dollar for dollar tax. So if you've got a $100 offset, that'll be saving you $100 in tax. It's always important that you're keeping your tax records because the onus is on you, the taxpayer, to prove that you've had that expense and how it related to work purposes. Generally, you need to keep those tax records, depending on your circumstances, between 4 and 5 years. Those records can be maintained either electronically or physically in paper version. Also, don't forget about the Griffith Tax Clinic. It's a student-run clinic where you can get free advice from Griffith University tax students under the supervision of experienced tax practitioners. The Griffith Tax Clinic may be able to assist you with getting advice about a tax matter, responding to a notice from the tax office, helping you in terms of getting your tax return material together, how to navigate My Government, and also how, if you're dissatisfied with assessment, how to know what your rights are in terms of appealing that assessment. Eligibility to get advice from the Griffith Tax Clinic are for people who are currently unrepresented, i.e. they don't have their own accountant or tax agent, they're living in Australia, and they're an individual or a small business. If you are interested to apply, please go to our website. Just Google Griffith Tax Clinic and you'll see our application form online. The Griffith Tax Clinic, we're here to help. Thank you.